Well, it's been just over 3 years since the COVID-19 pandemic first struck, and it certainly seems like we've been stuck in a permacrisis since. While the period following on the global financial crisis, the post-GFC period, was one marked by relative stability and even a sense of calmness, that is no longer the case. And here we are, almost at the end of 2023, and it certainly seems like we're reflecting on another year filled with volatility and uncertainty. So joining me is Anet, Ahern, CEO of PSG Asset Management, and we're reflecting on what we have seen so far in this year and what it means for investors. So Anet, just reflecting on what we've taken from the post-COVID-19 period, what do you think investors have learned?
Well, I would hope they've learned that volatility and uncertainty are almost always infused with opportunity. So we have certainly seen that being able to look through the short-term noise and particularly staying away from making short-term macro forecasts, that's something that investors should really have learned again and again over the last few years. I mean, if we just look at this year, there was a very well-known consensus that, oh my word, if the Fed hikes more than twice, the US is going to go into recession. And yet here we are facing possibly a quarter of growth in excess of 4% with after the 21st hike, I think it is. So I think it's very dangerous to build your portfolio around common consensus, short-term forecasts, and high conviction macro forecasts. So if anybody in this had looked at that and stayed away from growth assets over the last few years, they really would have missed out. They would have got to completely the wrong portfolio conclusion based on the short-term noise. And I think the other thing is that when there's uncertainty and volatility, it inevitably leads to neglected areas, it leads to overreaction, emotional price reaction. And if you have done your bottom-up work and always obviously being aware of the environment when you don't operate in a vacuum, if you've done your bottom-up work, you can really take advantage of some of those opportunities in areas that people would not normally be looking if they're listening to the general news and the general forecasts.
So the past 3 years have been some of the most challenging times, I think, that we have seen in the asset management industry. And the question that I have there been any lessons learned for PSG Asset Management, and has there been any changes in the process as a result?
So our process is still exactly the same, but I think not a year goes by that there's not some little tweak we make in terms of improving a part of it or improving the data the way we use data, and improving some of our structures and systems, streamlining some of our forums. So I think there's always some improvement that we make along the way. And I think over the last few years, one of the areas we've been very successful in has been to overlay more scenarios and to overlay some kind of macro awareness while still resolutely remaining a bottom-up house and doing our bottom-up research, so that we think we are better than ever, placed better than ever to build portfolios that are robust across a couple of different scenarios. Because that's certainly, I think, what the past few years have taught us, is that you cannot pin your hopes on one scenario.
So looking forward, it certainly seems like volatility and uncertainty is a permanent feature of the environment, and it's here to stay. So what words of advice do you have to offer investors looking ahead?
I would repeat the view that we hold, that opportunity lies in those areas and at those times, more so than ever. I mean, an example would be some of the stocks that have contributed the most in our equity portfolios over this year have been stocks that operate in South Africa with a poor economy, with a load shedding. I mean, we're talking about things like Sun International, AECI, Udeco. These are not companies that would have been obvious to invest in at the beginning of the year. The other thing I would also say is that use all the tools that are available. So we're very fortunate in that we've done really well across a wide range of asset classes. Our multi-asset portfolios have had a contribution from every single part of the market and every single part of the process. So there's always a piece of the investment process that can work for you. So that would be definitely an important lesson. But the most important one is you cannot get stuck in the short-term noise. You have to stay calm. You have to look through things. And as asset managers, we have to do an even better job of explaining the value proposition that we have and what we can bring to a portfolio, and how excited we are about the investments in the portfolios that we manage for clients. We have to become even better at explaining that, because the hardest thing for the end investor during times like this is staying on course. So a lot of investors may have quite a good plan to start with, and it's quite a robust plan. And the danger is that they go off course. And the role we can play is to help articulate that and explain to investors the importance of including different types of assets in your portfolio, and most notably growth assets, even when things are uncertain.
Anet, it's been great talking to you today. Thank you so much for joining me.